and welcome to Bondcast, our podcast series where we discuss the latest trends in markets and our views. I'm Joann Spadigam, European Mate Strategist, and I'm joined by Ross Walker and Joann Nevruzi today. So hi everyone, we're coming just off the back of some very hot US CPI prints just now. Jan, what's your take on it and what does the print contain for today?
Yeah, like you said, CPI just released half an hour ago. And if you just look at what was expected from economist surveys and what we got, it was more or less in line. The headline came a little bit above expectation of 0.4 in the month, but that also contains what's called like the more volatile food and energy components. The core side was pretty much in line at 0.3 month on month. There's some goods and bads in inflation. 0.3 on its own is, of course, above the Fed's long-run target of 2% once you analyze that number. But, a couple of caveats in there, I think. First, core goods, which earlier in the pandemic had accelerated somewhat because of a combination of supply chain issues and high demand from the consumer. Those core goods prices that were showing significant increases month on month have now firmly moved into kind of like a deflationary territory. We got another negative 0.4 this month. And if you also look at one of the biggest contributors of the increase in core CPI, which was like the owner's equivalent rent, so the OER, all of these shelter measures that showed a 0.6 increase in the month, a notable jump from last month where it was 0.4. The details that we could start nitpicking the details of why that happened, but that measure is pretty lagged. It doesn't really track the shape of the current real, or at least like rental and real estate market. It's a pretty kind of a backward-looking measure. So it's hard to rely that in real time, and that's why the Fed has looked at measures such as what they call supercore, services supercore, just supercore CPI, where they strip out housing, they strip out energy and food. And if you kind of look at these measures, actually, once we exclude the shelter side, it looks like inflation is, I think, firmly where the Fed wants it to be, because eventually we want to return to this pre-pandemic environment of goods being in more or less in deflationary side, services coming in between 2 and 3%, and shelter similarly in like 2.5-3% range. That was how we got to the 2% target pre-pandemic. And that's kind of probably what would we expect to be going forward too. Shelter, in my view, is something that will keep trending lower despite what we saw this month. So I don't think it's anything alarming, particularly for what we would get from at the November meeting, but it just certainly opens the door for December.
So have we really changed anything on the back of the sprint in terms of our Fed view? Do we kind of still expect this pause in November? How does that leave December and after the sprint?
I think a pause in November is the more likely outcome in my mind. Interestingly, we had this situation where, with the curve steepening and long end yields selling off, Fed officials kind of came in with a little bit of a softer message that, if the curve keeps doing this, we don't have to hike as much. So that's one. And second, I don't think inflation on its own proved or should push markets into pricing in a lot more for November. I think, if anything, the risks are now shifting towards December. So I think we will maintain our hold for November and eventually hold for December too. But I can see the curve spilling into the December meeting and out of November even more, as people anticipate that we might get similar kind of like, maybe not an acceleration, but like a lack of disinflation over the next two inflation reports, which we'll get between now and December. So our view remains of no more hikes. The hiking cycle's over, and this should kind of like influence the path of when the first rate cut comes, rather than like how many more hikes going forward. So trying to answer your question, I don't think today's CPI should move the needle all that much for November.
And just in terms of rates markets this week, we've had a bit of a rally driven really by these geopolitical tensions. What do you think investors should really make of the kind of moves we're seeing in markets at the moment?
So a lot of that rally was actually seen in the long end, so like 10-year, 30-year. And I'd imagine that's a combination of the dovish Fed speak that came over the weekend, but also just the flight to quality that you usually tend to get in these type of environments. Steepeners are pretty popular trades. So unwind of those certainly added a little bit to momentum by buying back the long end of the Treasury curve, but also generally the front end of of the U.S. yield curve is more or less pinned. There's so much you can price in terms of cuts. There's so much you can price in terms of hikes. In fact, there's very little you can price in terms of hikes. So a lot of this duration buying, the flight to quality will go through the long end. So I think that's probably enough for the U.S. today. And we have our special guest today, Ross Walker, with us, and I'm going to switch over to the U.K. I mean, we had a big week in the U.S., but next week will be the big one for the U.K. We will get a lot of labor market data. We will get the CPI data. That comes ahead of the November meeting as well, the BOE meeting. So can you just walk us through what we're expecting there, and should that make a difference?
Yes, I mean, markets are quite finely balanced in terms of that pricing for the November meeting, 9 or 10 basis points of hikes priced in, maybe a little bit toppy in our view, but clearly a relatively close call. And as you say, the labor market data on Tuesday, the 17th, and then inflation the day after, I think will be really the key determinants of that November decision. So on the wage side, I think we'll almost certainly see headline earnings measure tick down. We've got 8.2% as our forecast, down from 8.5%. That recent boost on the headline rate came to a large degree from some essentially one-off public sector bonus type payments. So that's not an ongoing influence. We can see the headline rate come back down. On the underlying regular pay growth measure, that may, we think, stabilize at 7.8%. I think to unsettle markets, to get a more sort of hawkish sense of, a real sense of hawkish risk around November, you might need that X bonuses rate to have an 8 handle. The next day, CPI, probably core CPI, will be more of the focus. We had a huge fall in last month's data from 6.9 to 6.2%. Prior to that, the UK core inflation numbers really had left the UK looking like quite an outlier versus the US and the Eurozone. So that last set of inflation data brought the UK back into the pack. We think we might just see a partial rebound up to 6.3% on core CPI. We've got a bit of extra auto fuel pushing up the headline rate. But again, to spook the markets and to get a real likelihood of a quarter point rise, I think maybe that core CPI measure would have to be coming in above 6.5%, something like that, I think, really to alter current market prices.
And to take a step back and just looking at the outlook for the Bank of England, I mean, I'm curious to hear about the rate outlook generally. Today we had the BOE's chief economist, Hugh Pill, basically saying that the outlook was finally balanced in his word. Is it really finally balanced, or do we differ in our views there?
Yeah, I think, if you go back to June, not that long ago, the Bank of England surprised the markets with a half-point rise in rates. And really, since then, we've seen a scaling back of the hawkishness, both in terms of actual policy delivery, but also in terms of the rhetoric. And you're right, Hugh Pill was quite guarded in his comments this week at the Marrakesh event. But he did also reference quite clearly that there's a lot of tightening still to come in the pipeline. Policy action they've already taken, but has yet to filter through, particularly the UK's mortgage market, where fixed rate products, including 5-year maturity fixed rate mortgages, are very prominent. So there seems to be, just at the margin, a little bit more acknowledgement from those mainstream MPC members, including Hugh Pill, that there's still quite a lot of tightening coming through in the pipeline. And we have, as we saw with this week's GDP data, we're probably going to get a negative third quarter GDP print. So the economy, which has already been stagnating, there's that, more, the evidence is building of more loss of momentum. And as I say, risks of a negative Q3. So in that context, that you would think would induce a little bit of caution. Those activity and employment indicators are just starting to roll over a little.
And in that context, what is the peak for the Bank of England? And if anything, when do we expect the first rate cuts, right? Like, just similar to what we have in the US, the Bank of England has been pushing against the idea of rate cuts as well. But when do we see this easing officially starting?
So we think where we are now, 5.25 is the peak. There is obviously some risk around November. We'd maybe put the risk of a quarter point rise at around 20%, not the sort of 40% territory that the market is currently pricing. I think, in terms of the sort of sequencing of rate cuts, we certainly find it, we think it's easier to see a scenario where maybe the ECB and the Fed are cutting before the Bank of England, because UK inflation has been a little bit higher and a bit stickier. So a first half of 2024 rate cut might be a little bit early at this juncture, unless we were to get a bigger deterioration than we expect in GDP. So we're looking at Q3, maybe around the August monetary policy report for the first BOE cut. And I think because, in our view, we are clearly now in restrictive territory. And even the BOE's most hawkish member, Catherine Mann, who is something of an outlier, I would say, within that 9-member committee, I mean, even she is acknowledging that current settings are restrictive. I think we can get a reset at some point relatively quickly, maybe 250 basis point type cuts in the second half of next year, just to reset policy at more neutral levels. So we're looking at maybe a 4.25% bank rate by the end of 2024. Beyond that, well, we're getting probably beyond the forecastable horizon, but maybe not much more easing beyond that, but maybe rates settling around 4% in early 2025.
I'll look past the Bank of England, but after that, on the 22nd of November, we will get the autumn statement too. So on the fiscal side, which is the de facto budget for next year. So we're looking for any fireworks there.
This is probably two big budgets, essentially fiscal events, before the next UK general election around this time next year, we expect. The borrowing numbers the fiscal position in general is quite difficult, and it's really a very tight fiscal outlook over the medium term. But in the current year, we have 5 months or so of monthly public finances data, and we've seen repeated undershoots in borrowing versus the official forecast. So there's a little bit of fiscal leeway for the government in the near term. If you extrapolated the numbers we have to date, you could make the case that maybe they have up to £20 billion, a percentage point or so of GDP to play with. Now, the signals at the moment are that don't expect any tax cuts in November. The government is still prioritizing getting inflation down, halving inflation by the end of the year. So I think the giveaways in November may be a little bit more limited. We'll get some, but I think the main fiscal fireworks will be saved until the March budget next year, a little bit closer to the election. Presumably part of that package will be some, headline grabbing tax rate cuts, a penny off the basic rate, something like that. For November, maybe a little bit of extra public expenditure. Obviously, there are rising defense commitments, some education, infrastructure, school rebuilding, healthcare sector is always under pressure during the winter. So November, I think, will be a little bit more about additional public spending, pre-election tax cuts next spring.
I'm going to shift gears and move to Europe to you, Joann. So we've heard quite a lot from ECB speakers. We also got the ECB minutes. Anything from the speakers or the minutes that has changed your view on the outlook for the ECB?
Yes, I think in terms of speakers, I think there's been a bit of a shift, I think, in terms of the hawks. Just in terms of them actually realizing or saying that they do think inflationary pressures are waning at this point in the cycle. So I do think this high for long message seems to be coming out for the ECB. Hawks as well seem to be suggesting that this is the end of the cycle. And I think the ECB minutes similarly paint a very similar picture where, there was, of course, this shift in market pricing right before the meeting, moving from kind of no hikes to hike, and the ECB obviously actually coming in and hiking. There was a lot of discussion, I think, around that. And of course, there were some members that did dissent or did actually not want that kind of hike to go through. But I do think the overall message for the ECB seems like there was this point between 3.75 and 4% that they did think would bring inflation back to target. I do think that obviously CAP and MRR were not really mentioned in the minutes, but obviously I think in terms of CAP, there's been a lot of discussion on what that means. there's a lot of different views around the committee in terms of PAP. I think there's a lot of views on the market as well on whether PAP will be moved forward, or the start of PAP production will be moved forward next year. And it's kind of our base case that happens in mid-2024. And I do think that the balance sheet unwind question is becoming increasingly important, especially for the hawks in the committee, and as we get to this normalization in policy conditions. So I do think the PAP story will become more relevant over the end of the year. Obviously, with that being said, the global context and the kind of condition of spreads will, of course, be a key factor in determining that. I think the one interesting thing as well to draw out for the minutes was on wage inflation, where kind of Q1 wage inflation data will be quite important for informing the rate cutting cycle. Of course, our expectation for cuts is that they actually come in March 24, which is a bit ahead of market pricing and potentially ahead of when we get this wage inflation data in Europe. But we do think that the growth picture and the growth forecast that the ECB will provide in December and potentially even March will actually show that the growth picture is deteriorating, or the growth estimates will be lower than they actually put forward for at the last meeting, given that I think the data was a bit stale. So this kind of reduction in growth whilst inflation is coming down should really, I think, set us up for a March 24 cut. But I think, of course, everything is context dependent, especially in this kind of environment where geopolitics is also playing a role in kind of how inflation may play out going forwards.
So you mentioned it depends on geopolitics too, and similar to the rest of global fixed income, European fixed income rallied as well. Do you have any particular changes in your directional view on the back of that, or you maintain your current stance?
So we were bearish as of last week, but I do think the interesting point in Europe is that, of course, I think the ECB, unlike the Bank of England and the Fed, have called the end of the cycle, I think, a bit more specifically. And I think the language there does kind of indicate that the cycle is here. So the front end does remain fairly pinned. But the back end, I think, is super exposed to cross-country correlations, like we said last week, where I suppose this time around and this week, it's actually moving in a more bullish direction, given that we've had pretty strong kind of risk off after we've got this geopolitical news. And I think, of course, what you kind of said already, Jan, on the Fed, and the Fed kind of dialing back that hawkishness, clearly has implications for Europe as well. So I do think that for now, it does seem quite unlikely that the momentum shifts bearish, at least for now, given that we have this kind of uncertain geopolitical situation and Fed numbers that are suggesting a bit less hawkish of a tone than they were previously.
And to wrap up with Italy here, Italian spreads are now under 200 basis points. And given what's going on with the economy and an outlook for like general weakness in across the euro area, do we expect to see any widening there?
Yeah, so I think BTP spreads got to highs of 207 basis points this week, and Italy has not really been driven by Italian specific factors, I would say, in the last couple of weeks at least. It seems like the high beta to core rates pushed BTPs above 200. It seems like negative risk sentiment as well has pushed BTPs past 200. So I'm not really that concerned, or not that surprised that actually BTPs have come down under 200 basis points this week, after what we've seen. But to me, I think the general story for Italy over the rest of the year really is the story of potentially a bit more widening. Our BTP target for the end year for 10-year BTP bond spreads is 210 basis points. And I think that's really just driven by the story that the ECB will start to consider PEP a bit more, or start to talk about it. And PEP, of course, there's been a lot of kind of support for the BTP spread through PEP, which means that any kind of indication that PEP is coming off could spook the markets a little bit. But I think just to add on this, I think in terms of PEP, the ECB has obviously come in with some sources articles this week stating that they're like in no rush to really unwind it. I think they're obviously a bit cautious given where spreads have got to at the moment. But I do think whatever happens with PEP, they will obviously be very mindful of where the spread is and what that could do to the spread. So I do think that they could potentially look for a solution where they have a PEP that is only partially reinvested, so that they kind of have this tool where they're able to control the spread by sort of partially reinvesting and keeping that kind of flexibility, if you will, going forward. And also they have this TPI instrument as well, which could also be used in case spreads do kind of move too quickly or too wide. So I would say that what happens on PEG, again, is very conditional on the context and I suppose the levels we're seeing then. If we get a scenario where growth is deteriorating really sharply, or we have kind of a shift in macroeconomic scenarios for next year, it could shift the outlook. But I think from where we're standing now, there could be a way to progress PEG even with, I suppose, keeping the flexibility.
All right. Okay. I think this is probably all we have for this week. And thanks everyone for listening in. If you like this podcast, please subscribe to wherever you get your podcasts, whether it's Spotify, Apple Podcasts, or if you want to watch us do this, if you want to see our faces as we record this, it's on YouTube as well. So thanks for dialing in, and we'll be back with Imogen next week where she can do these outros much better than I do. So bear with us. Thanks.